This is Bloomberg Daybreak. I'm Nathan Hager alongside Karen Moscow, getting you ready for the trading day ahead. Our guest this morning for that, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Great to have you back on with us on Daybreak this morning, Mike. And it looks like a lot of investors, particularly retail investors, took your advice to buy the dip after the Moody's downgrade last Friday. Now with futures moving a little bit lower this morning, I guess the question is, now what for this market? Good morning.
Good morning, Nathan. Yeah. Well, I mean, part of the sort of buying the dip is a factor of the retail community who has been actively buying every dip really for the last 2 years. In fact, they bought right through, Liberation Week, I would call it, that whole kind of episode. They didn't really flinch. And there's also the systematic strategies, the CTAs, and of course, corporate buyers. So there's just a lot of demand that is just coming in, and I don't see that really changing in the near term. It doesn't mean we're going straight up, by the way. There'll be pullbacks and whatnot, but I do think, going back to the Moody's downgrade specifically, it was the third agency that has downgraded U.S. debt, and it was really the first two that had a forced impact on folks having to sell because of that downgrade. So we just felt like that was not going to be a major reason for stocks to sell off. Now, I do think the bond yields above 4.5% on U.S. Treasuries, I do think if that persists and we go higher, that could lead to some corrective activity.
Okay. As far as the Moody's downgrade goes, though, Mike, does it feed into this narrative that we've seen play out in the market following the Liberation Day announcement that the U.S. might be a shakier buy for foreign investors? What's your view on that?
I do think there's some truth to that, but I mean, I don't know if it's directly related to the downgrade of U.S. debt. I think there's a lot of things going on that suggests that foreign investors may want to pare back their U.S. dollar asset investments. Number one being they just got too much of them. I mean, they over the last 20 years, they've acquired a lot of U.S. assets, both treasuries and stocks. And we know that, a lot of these indices are imbalanced because of that. So some of that, rebalancing is a good idea. And I would just point out that a lot of that rebalancing has already happened just through price, right? A lot of the foreign stocks in U.S. dollar terms did quite a bit better than U.S. stocks in the first quarter of the year. So as I like to say, the rebalancing happened through the price channel. And now the question is, are foreign investors more comfortable now where we are today? I mean, they own less. Is that enough? I think it's probably fine where they are. We focus on the fundamentals, Nathan, as you know. I mean, earnings revision breath bottomed, about a month ago. Both on an absolute and on a relative basis, meaning U.S. stocks are showing better earnings revision breath now. And ultimately, if that's going to continue, which we think it could, some of that, by the way, is the weaker dollar helping, then, I would suggest that U.S. stocks probably continue to do as good, if not better than foreign stocks.
You mentioned the earnings breadth continuing. Of course, a lot of what's been driving the rally once again, even in the last few days, has been those Magnificent Seven names that have been driving things for so long. Sticking to the fundamentals, how do you view those companies in terms of their fundamentals?
Well, that's just it. I mean, the reason why those stocks have performed so well for the last 10 years is really an earnings story, and it's really undeniable. Now, some have shown better earnings and more consistent earnings than others, but as a group, it's these are monopolistic type businesses, and so they are earners, and that's being shown again that the revision breadth for that group in particular has turned up again. Once again, some of that is a weaker dollar helping, but they go through these cycles where they self-correct, and then the earnings power just resumes. And I think, so in other words, this recent snapback by the Magnificent Seven is driven by the fundamentals. This is not just passive flows going back in there. They're showing good relative earnings revision breadth.
And in terms of the broader market, do you see that fundamental story continuing even with some of this uncertainty around trade negotiations continuing?
Well, we've had a big snapback, so I think we're of the view that we're probably kind of back on track to our original forecast for this year, which was that the first half would be tough. And our original range was 5,500 to 6,100. We're right smack dab in the middle of that again. But we do still think, we're going to break out of that range in the second half. And this is all related to the sequencing of the policy, a few other things as well. AI, CapEx, decelerated in the first quarter, but all those things now sort of stabilized. And if you think about, this administration, they came in doing all the sort of growth negative policy changes to start. You could say the president is acting like a new CEO. He's coming in and sort of kitchen sinking it. And then in the second half is when the more positive strategies or policies will start to flow through. Things like deregulation. We think there'll be success in passing this tax bill or budget reconciliation. And then, of course, we can get some of the animal spirits going that people were excited about 4 or 5 months ago. And that should lead to better growth in 2026. And I want to come back again to AI CapEx. AI CapEx has probably decelerated, but it's not going negative. And what we're looking forward to now on AI is the productivity benefits that'll probably start to come through next year. The market will start to figure that out in the second half of 2025.
Only got about 37 seconds left, Mike, but does that positivity in the second half continue even with the Fed on the sidelines? We keep hearing a lot of Fed officials hinting that they may have to stay on the sidelines for a little longer.
Well, I'm glad you brought that up. I mean, our economists probably have the least amount of cuts priced in of the major folks out there. We have no cuts priced in for this year, but then they have 7 cuts priced in for next year. So it's coming. Is the bottom line. And once again, even if there's no cuts in the second half of this year, the market will start to look forward to those cuts next year. So I think the Fed is another example of where the rate of change is going to start to turn into a tailwind at some point in the next 6 months.